They waited until the very last moment. They waited until the trading volumes were thin and the world was distracted by holiday celebrations. They waited until the order books were closing and the liquidity had evaporated from the halls of Wall Street. And then, on the final trading day of the year, the most powerful financial institutions in the world pulled the rug. If you are looking at your screen right now, you are witnessing a sea of red that defies normal market logic. You are seeing silver, an asset that has shown incredible strength all year, crashing down from its highs of $75 per ounce. In a matter of hours, it has plummeted to $70.50. This is not just a dip. This is an 8% drop in a single session. For many of you, this feels like a betrayal. You held through the volatility of the summer. You believed in the fundamental breakout. You stood strong while the mainstream media told you to sell. And now, just hours before we ring in the new year, your portfolio is bleeding. The gains of the last 48 hours have been wiped out as if they never existed. But I am here to tell you that what you are witnessing is not a change in the long-term trend. It is not a signal that the bull market for silver is dead. What we are dissecting today is a clinical, cold, and calculated liquidity event. It is a desperate dash for cash, driven by the cold machinery of global banking regulations. While the retail world sleeps, the biggest banks in the world are being forced by bureaucratic rules to dump their most liquid assets and hoard US dollars before the clock strikes midnight on December 31st. In this emergency market analysis, we are going to go inside the belly of the beast. We are going to explain why gold and silver are crashing in perfect unison. We are going to look at the specific regulations that mandate this year-end sell-off. Most importantly, we are going to explain why this massacre is actually the perfect setup for the January effect that begins in less than 48 hours. The banks are cleaning their books for the regulators. They are shaking the tree one last time to see how many weak hands will drop their fruit. Do not let them take what belongs to you. This is the story of the final flush, the moment where the paper market disconnects from reality to serve the masters of the fiat system. The storm is here, but the foundation remains unshakable. We are entering the eye of the liquidity storm, and by the end of this analysis, you will understand exactly why $70 is not the end, but the launch pad for 2026. To understand why silver is dropping with such violence today, you have to stop thinking like a trader and start thinking like a bank auditor on December 31st. Today is not a day for profit and loss in the traditional sense. It is not a day for speculation or following the chart. Today is an accounting day. At the stroke of midnight tonight, global regulators will take a high-definition snapshot of every major bank's balance sheet. This single moment in time is the most important date on the financial calendar for institutions like JP Morgan, Goldman Sachs, and Citibank. This snapshot is the basis for their capital requirements for the entire next year. In the world of high finance, every asset has a risk weight. If a bank is holding volatile assets like silver, gold, or stocks, their systemic risk score, known as the G-SIB score, begins to climb. A higher score is a disaster for a bank's bottom line. If their score increases by even a small fraction, the Federal Reserve and the Bank for International Settlements will force them to hold billions of dollars in extra capital reserves. These are billions of dollars that the bank cannot lend out, cannot invest, and cannot use to generate profit. So, what is the logical, cold-blooded move for a chief financial officer at a major bank? You sell everything that carries a risk weight. You sell the gold, you sell the silver, you sell the corporate bonds, and you get to cash. Cash is the only asset that carries a zero risk weight in the eyes of the regulator. It is the only asset that lowers the risk score and frees up capital for the coming year. Therefore, the massive red candles you see on your screen right now are not the result of a sudden change in industrial demand. They are not because Samsung stopped buying silver for semiconductors or because the silver shortage has magically ended. These moves are purely mechanical. They are the result of JP Morgan and Citibank needing to show a mountain of cash on hand to the Federal Reserve by tonight. They are dumping massive positions into an extremely thin holiday market to dress the window of their balance sheets. Because there are so few buyers active on New Year's Eve, their selling has an outsized, exaggerated impact on the price. When they sell 1,000 contracts on a normal Tuesday, the price might move 10 cents. But when they sell those same contracts today, the price drops $2. They are forcing the price down to raise liquidity at any cost. But remember this crucial fact. Once the clock strikes midnight, the regulatory rule no longer applies. The pressure lifts, and the capital is free to flow back into the market. This is why the first week of January often sees a vertical recovery. You are watching the sell leg of a massive accounting trade. The buy leg is scheduled for Friday morning. To truly grasp the magnitude of what is happening, we must look at the invisible architecture of the global financial system. We are talking about the Basel III regulations. These are not merely suggestions. They are the international standard for bank capital adequacy, stress testing, and market liquidity risk. Under these rules, banks are categorized based on their importance to the global economy. This is where the G-SIB score, or the Global Systemically Important Bank Score, comes into play. It is a mathematical formula that measures a bank's size, interconnectedness, and complexity. The higher a bank's G-SIB score, the higher the capital surcharge they must maintain. For a giant like JP Morgan, a jump into a higher bucket could mean an extra 0.5% capital requirement. While that sounds small, on a multi-trillion-dollar balance sheet, that equals billions of dollars in locked capital. The regulators calculate this score based on the year-end values of a bank's holdings. This creates a massive incentive for banks to engage in what we call window dressing. They want their balance sheet to look as small and as safe as possible on December 31st. Gold and silver, despite being Tier 1 assets under certain Basel III rules, still carry market risk weightings in the G-SIB calculation. In a period of high volatility, these precious metals can inflate a bank's risk score. By dumping paper silver contracts and physical holdings into the year-end, the banks are effectively shrinking their risk profile for the auditor's camera. They are exchanging a volatile, high-risk asset for the ultimate zero-risk asset, the US dollar. This is why we see a dash for cash. In the eyes of a central bank regulator, $100 million in silver is a liability that requires a capital buffer. But $100 million in cash is a pure asset that strengthens the bank's stability. The banks are not selling because they think silver is going to zero. They are selling because they are being punished for holding it on this specific day. This is a regulatory flush of the highest order. The irony is profound. The very regulations designed to make the banking system safer are the ones causing this extreme market instability and the 80% crash in silver prices today. We are watching the system cannibalize itself to meet a bureaucratic deadline. However, this artificial selling creates a massive vacuum. Because the selling is not based on a change in silver's value, but on a temporary need for a cleaner balance sheet, the moment the new year begins, the banks no longer have a reason to hide. The capital that was sidelined for the snapshot is suddenly unlocked and ready to be redeployed. The very same institutions that are crushing the price today will be the ones chasing it higher on January 2nd to rebuild their positions for the new fiscal year. In the world of macroeconomics, everything is priced in relative terms, and the US dollar is the sun around which every other planet orbits. When banks around the world start dumping assets to raise cash, they are not just selling, they are buying dollars. This creates a massive, artificial spike in demand for the greenback. If you look at the dollar index, or the DXY, you will see it rallying today with incredible strength. But do not be fooled by the headlines. The dollar is not rising because the American economy is suddenly stronger or because the federal deficit has vanished. It is rising because there is a temporary, desperate shortage of dollars in the global banking system to meet these year-end requirements. This dollar spike acts as a wrecking ball. Because gold and silver are priced in dollars, any jump in the value of the currency automatically exerts downward pressure on the price of the metal. It is a simple mathematical inverse correlation. When the dollar index gains 1%, silver often drops 3 or 4%. Today, with the dollar screaming higher as banks scramble for liquidity, silver is being smashed by the sheer weight of the currency. This is what we call a liquidity squeeze. It is a moment where the medium of exchange, the dollar, becomes more valuable than the assets it is meant to price, simply because everyone needs to hold the currency at the exact same time. The Federal Reserve is fully aware that this dollar shortage exists. In fact, they often have to intervene in what is known as the repo market to provide emergency liquidity to banks that cannot find enough dollars to balance their books. Tonight, as the banks fight for every last cent, the Fed will likely inject hundreds of billions of dollars through these overnight facilities to stabilize the system. This is the ultimate paradox. The banks sell silver to get dollars, the dollar price of silver crashes, and then the Fed prints more dollars to keep the banks from collapsing. You must remember that a liquidity crisis is, by its very nature, a temporary event. The dollar index cannot sustain this vertical climb once the regulatory deadline passes. When the fresh liquidity from the Fed hits the system and the year-end requirements are satisfied, the demand for the dollar will fall just as fast as it rose. The wrecking ball will swing back. As the dollar retreats, the massive suppression on precious metals will be lifted. We are currently in the eye of the liquidity storm, watching a fake rally in the dollar hide a massive buying opportunity in silver. The dollar is the hammer, but silver is the anvil, and the anvil always outlasts the hammer. Let us pivot to the reality of the physical market, because this is where the manipulation of the paper market meets the immovable wall of physical gold and silver. If you look at your computer screen right now, the digits say silver is $70.50. Mathematically, you should be able to go to a dealer and buy an American Silver Eagle for $74 or $75. But go to the major dealer websites right now and try to find that price. You will see something shocking. The premiums have expanded almost instantly. While the spot price on the COMEX crashed by 8%, the actual price to take delivery of a physical ounce has barely moved. Yesterday, the premium over spot might have been $10. Today, it has jumped to $12, $15, or even $20. The dealers are refusing to lower their prices in line with the paper crash. Why is this happening? Because the dealers know this crash is a manufactured event. They know it is a paper slaughter driven by accounting rules, not a reflection of the supply and demand for actual metal. If a dealer sells you a coin for $74 today and the paper price snaps back to $80 on Friday, they cannot replace their inventory without taking a massive loss. So, they hold the line. They are pricing silver based on its real value, not its temporary liquidity value. This disconnect is your most important signal. When the spot price drops but the street price stays high, it means there is no panic selling in the real world. Nobody is lining up at the local coin shop to sell their silver bars because of a one-day drop. The only people selling are leveraged traders staring at a computer screen and algorithmic programs triggered by technical levels. The physical market is the truth, while the paper market is the illusion created by the banking system. You must trust the atoms over the pixels. The physical market tells us that supply is incredibly tight. There are no massive hoards of silver waiting to be dumped. In fact, most major dealers are already reporting shipping delays and limited stock. They are protecting their inventory because they know that once this paper storm passes, the rush to own physical metal will only intensify. The banks can print an infinite number of silver contracts to drive the paper price down, but they cannot print a single ounce of silver to satisfy a buyer who wants to hold the metal in their hand. This year-end massacre is a gift for those who understand this distinction. It is an opportunity to buy the base price before the physical market completely breaks away from the paper manipulation. While the speculators are panicking and the banks are window dressing their balance sheets, there is another group of players watching the screen with a very different emotion. Pure excitement. I am talking about the industrial giants. Imagine you are a procurement officer for a company like Tesla, Samsung, or a massive solar panel manufacturer in China. You have a budget to buy millions of ounces of silver for your production lines in January and February. Yesterday, the price was $75. Today, it is $70.50. To a manufacturer, this is not a crash. It is a once-in-a-year gift. These industrial users do not care about the Basel III regulations or the G-SIB scores of the big banks. They care about their bottom line and their supply chain security. Silver is the most conductive element on the periodic table. It is an absolute necessity for the green energy transition, for high-end electronics, and for advanced weaponry. There is no substitute. When the price drops 8% in a single day for no fundamental reason, these corporations issue buy orders as fast as they can. They are using this temporary dip to lower their average cost for the entire coming year. This industrial buying provides what we call a hard floor under the market. The paper price can only drop so far before the real-world users step in and buy every single ounce available at that discount. We believe that hard floor is right here at the $70 level. Below $70, the value proposition for a manufacturer is simply too good to ignore. At these prices, the factories will clean out the vaults of any physical metal they can find. What the banks are doing is effectively subsidizing the industrial sector. By dumping paper silver to fix their accounting, they are allowing industrial users to take physical delivery at a massive discount. This accelerates the long-term shortage. It moves silver from weak hands, who are trading on leverage, to strong hands, who are going to melt the metal and put it into a product where it will never return to the market. Once silver is embedded in a solar panel or a cruise missile, it is gone. This year-end flush is not just a price event. It is a massive transfer of wealth and resources. The banks are focused on tonight's balance sheet, but the industry is focused on the next decade of production. By the time the banks realize their mistake on January 2nd, the physical silver they depressed will already be on a ship heading to a factory. The most dangerous game being played right now is not by the investors who are holding, but by the institutions that are selling. To drive the price of silver down by 8% in a single day, the banks did not just sell the metal they owned. In many cases, they had to open new short positions. They sold silver they do not have, promising to deliver it at a future date, all to create the downward pressure needed to lower their year-end risk scores. This means they have dug a deeper hole for themselves. They have moved from a position of systemic risk to a position of extreme market liability. This is the setup for a massive short squeeze. The banks managed to cover some of their short positions earlier this month, but today's desperate move has forced them back into the trap. They sold new contracts at $70.50 to push the price down. But here's the problem. Those contracts must be closed or rolled over eventually. They are kicking the can down the road, but they are kicking it uphill. On January 2nd, when the new capital enters the market and the industrial buyers continue their raid, the banks will be forced to buy back these new shorts at a much higher price. Every ounce they sell today is an ounce they must buy back tomorrow. When you have a market that is already in a physical deficit and you add a sudden surge of institutional buying in the new year, the shorts get squeezed. They become the fuel for the very rally they tried to prevent. We have seen this pattern many times in market history. A violent, artificial move to the downside is often followed by an even more violent move to the upside as the shorts scramble to exit their positions before they are wiped out. The short interest is building up again right at the $70 support level. This guarantees future volatility to the upside. The banks are playing a game of musical chairs, and the music is about to stop. They think they are being clever by manipulating the year-end snapshot, but they are actually providing the energy for a massive slingshot effect. Do not be surprised if we see silver jump $5 in a single session next week. The banks are back in the trap. And this time, the exit door is much smaller than it was before. They are trading temporary accounting relief for long-term financial catastrophe. Why does January 2nd matter so much? Why is this date whispered with such anticipation in the halls of hedge funds and family offices? It is because of a phenomenon known as the January effect, and in 2026, this effect is going to be supercharged. While today is a day of forced selling and capital withdrawal, January 2nd is the day of the Great Reset. This is the moment when the new capital for the fiscal year is officially unlocked. We are talking about billions of dollars from pension funds, university endowments, and individual 401k contributions that flow into the market on the very first trading day of the year. Right now, the silver market is illiquid. There are no buyers because everyone is hiding behind their balance sheets. That is why the banks could push the price down so easily today. It is like pushing a car that has no driver and no brakes. But on Friday morning, the drivers return. The volume returns. When that wall of new money hits a price that has been artificially suppressed to $70, we are going to see a violent reversal. These massive funds have mandates to deploy capital into undervalued assets. After an 8% crash on no fundamental news, silver will be at the very top of their buy lists. Think of the market like a rubber band. The banks have spent all day today stretching that rubber band to the downside. They have pulled it as far as it can go, using every regulatory trick in the book. But they cannot hold it there forever. On January 2nd, they have to let go. When they do, the rubber band does not just return to its original shape. It snaps back with incredible speed and force. This is the slingshot mechanism. By pulling the price back to $70 today, the banks have loaded the energy for a launch on Friday. Do not be the person who sells at the bottom of the slingshot. The professional money is waiting for the open on Friday to scoop up the shares and the ounces that the panicked retail investors are throwing away today. This is the great transfer. The market is moving money from the impatient, who are staring at a red screen on New Year's Eve, to the patient, who understand the calendar cycles of the global banking system. The January effect is not just a theory. It is a structural reality of how global finance operates. The vacuum that was created by today's sell-off will be filled, and it will be filled with a vengeance. Now, let us lift our eyes from the flickering red candles on the screen and look toward the horizon. We are moving into 2026, a year that I believe will be remembered as the tipping point for the global silver market. To understand why, you must look at the math of supply and demand, which no bank regulation can change. We have been living through a structural silver deficit for 5 consecutive years. Every year, the world mines less silver than the industry consumes. We have been filling that gap by draining the massive vaults of London and New York. Mathematically, we are entering the 6th year of this deficit, and we are reaching the end of the line. This is the year the warehouse inventories could hit zero. In a normal market, when a commodity becomes scarce, the price rises slowly to encourage more production. But silver is not a normal market. Most silver is produced as a byproduct of mining copper, lead, and zinc. This means that even if the silver price doubles tomorrow, the miners cannot simply flip a switch to produce more. The supply is inelastic. This brings us to the concept of scarcity pricing. When an essential industrial material like silver runs out, the price mechanism changes. It stops being driven by hedge fund speculation or paper contracts on the COMEX. It starts being driven by the physical reality of a factory that has to shut down because it cannot find the silver atoms it needs. Scarcity pricing is not linear. It is exponential. It does not go up 10%. It moves until it destroys demand. We are looking at a year where silver could touch $150 per ounce. While it sounds impossible today, as you stare at a $70 price tag, remember history. We have seen oil move from $40 to $120 in a matter of months when supply chains broke. We have seen nickel move thousands of dollars in a single day. Silver is the most undervalued and essential commodity in the world right now. The debt of nations is still climbing, the energy transition is accelerating, and the physical metal is vanishing. Do not let the price action of a single day in December cloud your vision of the reality of 2026. Today, the banks gave you a gift. They gave you the chance to buy the most essential material of the future at a deep discount right before the world realizes there is none left to buy. We have reached the final chapter of this market alert. We have dissected the regulatory flush that drove silver down to $70.50. We have analyzed the contagion from the bond market and the panic selling by the hedge funds. We have looked at the physical dealers holding the line on premiums. Now, you are left with a portfolio that is battered but not broken. You are standing at the finish line of 2025. It has been a historic year of breakouts and awakenings, and it is ending with a final test of your conviction. So, what is the battle plan for Friday, January 2nd? First, do not look at your account balance today. Do not calculate your paper loss from the peak. It is a fake number based on a fake price. Instead, focus on your ounce count. If you still have the same number of ounces today as you had yesterday, you have lost nothing. The market is merely a mechanism for transferring wealth from the impatient to the patient. Today, you are being tested to see if you belong in the latter group. Second, watch the open on Friday at 8 o'clock in the morning Eastern Time. If we see a gap up in price on high volume, it is the confirmation that the bottom is in and the January effect has begun. This is your signal that the banks have finished their window dressing and are moving back into the market. Third, if you have cash on the sidelines, this is your window of opportunity. Look for the physical buy signal, when the spot price begins to stabilize but the premiums haven't yet exploded further. If you can acquire physical metal at an all-in price that is lower than what you saw last Monday, you are winning the game. Do not try to time the absolute bottom to the penny. You will miss the launch. The window of this discount will close the moment the institutional funds start their massive buy orders next week. The banks fired their last shot of the year today. They missed the heart, and now the bull is angry. You have survived the final flush of 2025. You held the line when others fled in terror. You proved that you have strong hands. As the sun sets on this year, celebrate the fact that you own the only asset that exists outside the failing fiat system. You own the money of the people. You own the energy of the future. When the market reopens in 2026, the scores reset, the rules change, and the silver market is ready to run. You were early, you were right, and most importantly, you are still here. Welcome to the year of the squeeze.